Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. Hey everyone, it's April 10th, 2022. This is podcast number 6. My name's Artie. I'm here with Gamma. Let's get started with the year-to-date performance. S&P 500 down 5.77%, Nasdaq down 12.24%, Russell down 11.05%, Dow Jones down 4.39%. The S&P is currently in neutral trend, and let's get started with the calendar. So Monday, we've got no important events. Tuesday, we've got CPI. This is what every other macro person's model runs on is CPI. So watch their models change based off of what happens here. We've got Treasury statement as well. Wednesday, we've got PPI final demand, EIA petroleum status report. Thursday, we've got jobless claims, retail sales, import and export prices, business inventories, and consumer sentiment, and EIA natural gas report. Friday, markets closed. Don't forget about that. We've got Empire State Manufacturing Index and industrial production and Treasury International Capital. So let's take a look at ES, what happened here in the last week. We had pretty steep decline, blew through Momo. We are in neutral trend, but could very easily switch back to bearish trend. It's pretty likely here with this stagflationary environment. We've got levels. We had a double bottom at 44, 45. If market breaks through below that, we'll likely see lower prices. Market banged on Momo the last 2 days. And if we break above Momo, we may see higher prices. But, this is stagflation. It's known to be choppy. So you got to be careful. It's not a risk on environment. Yeah. Today we are actually, hold on. Let's look at ZN as well. So ZN still nowhere near a buy. It's like catching a falling knife. We've got a deflationary trigger. So whenever we see deflation, we go balls deep into TMF. That's our strategy. And we've got a long way to go before that happens. We're going to likely have to go deep into positive real yields until ZN turns around. So for now, we do see a lot of people on Twitter trying to catch the falling knife and getting burnt. We're just waiting it out. Yeah, that's the market recap for the past week. Today, we want to talk about liquidity. So liquidity is something that you see people in the know, people that know a lot about macro, they often talk about liquidity. And so we want to talk about that today and the importance of liquidity. What does it mean, first of all, and how does it affect the markets? So let's start with that. Gamma.
Okay.
What is liquidity, first of all?
Right.
Let's start with that.
That's a good way to start. So I guess the best way to describe liquidity would be the extent at which participants can enter and exit trades at a current price without um a drastic price change. So if you have people come in that are looking to buy or people that are coming in and looking to sell, how much can the market take before you start to see a drastic price change?
So that's
Right.
basically like when you see like shit coins with no volume, and then they do a rug pull and it goes from being $100 a coin to zero. That means it's low liquidity.
Exactly, and I think another good way to present this topic would be to use an analogy like a grocery store, right? So let's just say you go to your local grocery store and there is a shelf of cans, right? And obviously, they're not selling out of a shelf. Excuse me, a shelf of soup cans. They're not selling out of a shelf of soup cans every single day, right? That you know, it's soup that people probably come take a can, 2 cans, 3 cans, but they're not clearing a whole shelf in a day, depending on the supermarket, of course, right? But like for the scenario, how many soup cans can you take from that shelf before they have to come and restock that shelf to finish the day? That's liquidity, right? So if you go into the grocery store and you buy, let's just say there's 100 cans on of soup on the shelf and you buy 99 cans, right? Odds are someone has to come and resupply the soup cans for the rest of the business day because there's a high chance that someone else is going to take at least one soup can, right? That's liquidity. The ability to come in and take but not affect the overall situation. That's considered great liquidity. Terrible liquidity would be, as you just said, a shitcoin or me coming in and buying 99 cans of soup and it's 9 o'clock in the morning.
Yeah.
Now they have to scramble and refill this, restock the shelf. That's basically what's going on. That's in layman's terms for those that are trying to simplify the situation.
Yeah. So
But
how does that relate to the market?
right. So I think when you look at liquidity, there's three main factors everyone is talking about, right? When it comes to market liquidity, it's how do you measure it? Number one, right? How do you make money with it? Number two, and can you forecast it? Number three, right? That's like the big thing. Can you forecast market liquidity? And in my opinion, you can, but it's not what you think. So Artie, as you know, our models are market priced, right? They're based on market pricing, not so much economic indicators. So our models updated live as things change. It tends to front run the cycle, but it's not something that we're going to be able to tell you 3 quarters out what's going to happen,
Yeah.
right? So most important thing to look at is the way that people measure it and understand it from there. Now, the common way of measuring liquidity, or at least the three that I know of that people use, and I've seen people use, is book depth, bid and ask spreads, and price dispersion. So you're probably going to ask me, what is book depth, right?
Yeah, what the hell is that?
Okay, that's the quantity of orders placed on an order book by the market makers. So if you look at a level 2, right, and you see all the lot, if you're looking at ES, you'll see the lots, right? Because there's no fractions, it's just 1, 2, 3, how many lots of ES are sitting there.
Yep.
You're basically scanning the order book and seeing how many lots are sitting there and what's the dollar amount of those lots. So if you were to calculate all the visible lots, you might get, I don't know, 20, 30, $50 million, right? Worth of lots sitting on live orders.
Yeah.
As that number increases, some would say the liquidity increases, right? Because there's more money sitting at an order book ready to be executed. Then there's bid and ask spreads. That's the difference between the at the money bid and at the money ask, the price difference, on a piece of shit, or we like to call them penny stocks, right? The bid and ask spread, might be 5 cents, might be 10 cents, might be $1.
So that's like a clear tell of low liquidity right there.
It tends to be, but we'll get into the topic of bid and ask spreads in a few seconds. There's also price dispersion, right? Price dispersion is the study of the rate of transactions at a certain given price. So how many transactions or how many lots are executed at this price? So
Okay.
if the market opens, right, uh, in the first 15 minutes of trading, how many lots are executed, and you run that over time, and what price deviation are those lots executed at? You're getting into like variations and variances and trying to understand liquidity in that fashion. But those are like the textbook ways that people on the internet are measuring liquidity, and I don't think that they're the best, especially for our listeners, because they don't encompass what we talk about. And I mean, while they do work, they have to almost be used all together at the same time. And most people don't have access to the data feeds that are required to compute these analyses. Again, I don't know how many people have book depth access or are doing
Well,
price dispersion
let alone
studies.
level 2.
Yeah, I mean, yeah, that's
Yeah.
true. The amount of people that the amount of people that don't even know what level 2 is quite interesting. But I believe that our followers have somewhat of an idea of what level 2 is. Like, I mean,
Well, let's
I'll
do a quick explanation
yeah,
for those
let's do
newbies out there, because so level 2, essentially, you have level 1 is you got the bid and the ask, so you know the closest bidder and the closest seller. So the level 2 essentially gives you more depth than that. You know the second closest seller, you know the third closest seller, what
right.
price they want to sell at. So you essentially have more depth. You can see how far out there are sellers and how much they're trying to sell at what price. So it just gives you more market depth.
Right. And I think the where we should segue from there after understanding what level 2 is into what does the three common metrics that everyone use or use everyone that everyone looks at having or how are they related, right? How is the three things everyone looks at related? And I would say that the way that they're all related is volatility. It's a factor of all book depth, spreads, and price dispersion, right? So a simple way to put it is a higher VIX instills less confidence with size by market participants, right? So, like a hedge fund uh, or a retail investor is going to have less confidence at VIX 30 than at VIX 9, right?
Hmm.
Another way to look at it is how do big institutions and funds act? Well, they need liquidity to enter and exit positions. It's like think about it, like a Bridgewater Capital, uh, SoftBank, all these big groups, they need liquidity to exchange positions or turn over their portfolios. Without it, they suffer they suffer what they end up suffering from is usually losses if they're unwinding a position from pushing the market in the wrong direction based on their actions of trying to exit or even enter the market.
Yeah, they're
They bid up
literally
the
like
security.
rug pulling themselves.
Yes, exactly, right? So they need liquidity to function. And they also do things like beta adjust their portfolios, use Sharp ratios, all this stuff for a reason because they're trying to like Ray Dalio's biggest achievement is reducing volatility while maintaining returns. That's the big thing. How can I get a really great Sharp ratio, right? Where you reduce the component of volatility, aka risk, and keep high returns because that's the ultimate key. Like if I told you that I could stair stepper your portfolio for 30 years in a constant straight line, you'd be more inclined than having super big gains, but also decent drawdowns.
Yeah.
Because the idea is at any single point in time, you may need that money, right? Or you may want that money back. And the idea is if you're in a drawdown, it's your life is almost put on hold. That's the whole reason why and also these funds are like um they're positioned in a way that they have to their number one key is preservation of capital and then returns are secondary. That's at least, Ray Dalio's whole concept. But this all stems back to VIX. So if we pull up VIX on our chart, you take a look. And we'll disable DDAP for the sake of discussion. So as you can see, um, VIX ever since COVID hasn't really returned to pre-COVID levels. Excuse me. And this is a sign that liquidity has never really recovered,
Hmm. Okay. Well,
right?
how does higher volatility show that liquidity hasn't recovered?
Well, remember, the liquidity in turn is inversely related to volatility because by higher volatility environments, you're going to have less liquidity in general because people just because VIX is higher doesn't mean people will want to assume more risk.
Okay.
Do you understand? So like if VIX go like let's just say VIX is at 21 right now and it goes to 41. And that person wants to assume risk, you think they're going to assume more or less risk?
Well, less for sure.
Right,
So
that's the whole
essentially,
point.
like they're more positioned in cash.
There's times and places where cash is a position, but it's more like think of it like this. a fund is going to have to adjust their portfolio for volatility, because at the end of the day, I got to correct myself. A very good fund. There's a bunch of jackasses that don't give a shit, but a very good fund is going to have to position their portfolio for volatility, because they can't suffer extensive drawdowns or loss of capital. Um, the hedge fund world, it's a very tight knit community. Everyone knows each other. It's all the big guys know each other. The small guys are trying to get bigger. That's how it works. But the problem that they're running into is they need to capture returns, but they can't risk drawing down capital, because a few bad quarters in the hedge fund industry, you're done. Unless you're someone like, if Ray Dalio put on a string of shitty quarters, he's got some selling power behind him. He's Ray Dalio. Same thing with Jim Simons. These guys, if they put a couple of shitty quarters like back to back, I mean, they can kind of defend themselves in that situation. But you got a new guy on the block that's trying to kill it. He's not going to want to put himself in a position where he could get fucked, right? So in turn, he's going to have less out there, more hedge, more hedge on the table, stuff like that. Now, that's exactly what you've been seeing, right? Like, you haven't seen ever since COVID started, we saw this huge rally, right? But some would say that huge rally was only possible by low liquidity.
Hmm. Okay.
Right? Go back to COVID. Do you ever see the market move up the way it did? Like, let's look at the SPY, right? You ever see the market move up like this in a straight line?
No.
Like, I think the biggest dip that we ever had it was in like the 5%, what is it, 5% corrections or something like that on the whole way up,
Okay. So,
right?
okay. I think I'm getting it.
Right. Now there's also a volume aspect. Like, some people will tell you, oh, this COVID drop was very liquid, a lot of volume, right? But we're gonna get into what we at Market Radar, the preferred level, or I should say the preferred view of indicator, or I simplify this, the best way to view liquidity. Number one, we just said it is VIX. Okay. Uh, Number two is actually a Fed index. It's the Chicago Fed National Financial Conditions Index. It's called the NFCI. That's the base. So if we type in NFCI, this is the Chicago Fed um, National Financial Conditions Index. And what this is showing you the financial conditions within the United States on a basis of standard deviations. Okay. And it's portrayed in a way that anything under zero is considered loose, anything above zero is considered tight. As you can see here, during COVID, we went from -67 to +31. We were in positive territory.
Wait,
In
so
2008,
the
we were
higher
in,
this is, the lower the liquidity?
or the more, and remember, like, let's actually define what financial conditions actually mean, right? So financial conditions is another word for stress, financial stress, or I should say the stress on the market. And let's go over what the NFCI is. It measures the financial conditions in money markets, debt and equities, and traditional plus shadow banking systems. Okay, that's the actual definition. Now, I'm assuming you're going to ask me, what is shadow banking, right?
Yeah.
Okay, yeah, I almost figured that you were
Yeah,
going to say
never,
that. So,
literally never heard that term in my life.
right. So, shadow banking is a Wall Street term for market-based financing institutions, and I guess the simplest way to put that is, if you have a mortgage company, right, that lends out loans, and you have a team of investors funding those loans, it's market based, and it's not like institutional, or not institutional. It's not like bank related. You know what I mean? It's
Okay.
it's raised it's raised by it's basically third party financed.
Yeah.
So that's considered shadow banking, because you're not really related to the Fed, or like
Okay.
the
Yeah.
banking system of the Fed. That's what that is.
Okay.
But this goes a step further. So we have the Chicago Fed National Financial Conditions Index, which is the NFCI on TradingView. You could type NFCI in and you'll pull it right up. And this goes to, there's a secondary index, an adjusted index to this. The adjusted index uses the NFCI, but adjusts it for the different angles of a business cycle involving growth and inflation, which works perfectly in our model, right? We look at growth and inflation the way the market's pricing in, or the way that the market is pricing it in, and the adjusted NFCI encompasses the NFCI but adjusts it accordingly across the business cycle. So if we type in A and then NFCI, we get the adjusted NFCI. And this is a little higher than the NFCI, but again, it's adjusted. So it reads a little differently, but we prefer to use the the adjusted NFCI rather than the NFCI because this is more relatable to our process and it encompasses more of the variables that we look at in general. So this again, you can see that ever since September, it's been increasing slowly, ever so slowly, right? And this is this is literally showing you liquidity is drying up. There's more stress continuously being put on, again, money markets, debt, equity markets, and the traditional banking system. It has increased stress over the last 6 or so months.
So that's basically saying that the market's getting fragile.
Yeah, that's a good way to put it. Now, if you look back in time, as you see, we go back to 2014, we had this, or 2013, the end of 2013, starting 2014, we had this ANFCI grind up slowly all the way till September of 2016, which, I mean, we all know what happened here. Donald Trump was elected. He basically deregulated and loosened up the financial conditions of the entire market, which is what you saw this plummet here,
Okay.
right? Like
Yeah.
tax cuts, basically stimulating the economy, which loosened the financial
Yeah.
conditions.
So more cash was flowing into the market, more market participants,
Hmm.
increasing liquidity.
Right, and then look at COVID. We saw COVID go vertical, right? Makes sense, right? There was extreme stress, and the change was so drastic within, I mean, with under a month, a little over a month, we literally moved we went from negative 80 to almost, actually above positive 60.
Yeah. And that
Very
that
drastic
makes
move.
sense, right? Because people exit
Right,
the markets. People
right,
don't want to put their cash in the markets. So
right.
less liquidity.
Exactly. And a good way to look at this is to say, a way to take a step back and look at this is not look at it like some Chicago Fed adjusted financial index. You're going to confuse yourself. Just call it the stress index. Real simple. This is the stress index. If this is above zero, um, we're getting very tight. Okay. If this is under zero, we're loose. Approaching zero, tighter, moving, approaching zero from under, getting tighter, approaching zero from above, getting looser. The lower you go, the looser it gets, the higher you go, the tighter it is. This is the financial stress index.
And
They have
so
other Go
so
ahead.
the lower this is, essentially that means like the more robust the market is, right?
Right. I mean, ever since like look at this is 2008, you know?
Yeah. Yeah,
We went
2008.
from we went from I'm going to not even going to refer to the decimal places. We went from negative 73 to positive 363.
Yeah.
Right? And that happened within what, 2 years?
That was way more
And
than the 2000 crash.
right, even in 2000, I mean, we went up, we went again though, remember what was 2008? It was a financial crisis. People lost faith in the stock market. They lost faith in this is what, remember 2008, 2009 was why Bitcoin was created.
Hmm.
It was there was so much uncertainty. I mean, you had big banks like Bear Stearns, like all these Lehman Brothers going belly up,
Yeah, so
right?
that's just so much liquidity drying up as well.
Right, that's my point. So there's a huge amount of stress being placed on the market.
Yeah.
But even you can see, like going into 2008, right? We had liquidity really started or I should say, started to dry after 2003. We were grinding higher, and then it was the big. After that, it just went vertical, or liquidity just really shrunk.
So what does this mean now? Now that liquidity's kind of spiked up here, I guess that kind of explains the drastic moves we've been having
You,
because
you want you want to
it's
see you
so
want to see
related with volatility.
you want to see something really interesting.
Yeah, let's see it.
Let's overlay volatility.
Oh, interesting. So
Right.
it seems like it kind of led volatility a little bit in 2008.
Yeah. Long story short, they move together. They're pretty. They move in the same fashion. Um, we go into let's go to a 1 year time frame. You know, let's go out a little bit to show the COVID drop. As you can see, they move together in somewhat. Volatility can front run. Remember, this is also a lagging indicator. This is reported weekly, so it makes sense that VIX will move ahead in some cases. But in 2008, it was a little different. Long story short, though, like I said earlier, looking at VIX is a great gauge of liquidity because less market participants are enticed to take action at a higher volatility level in the market because um, think of it like this, real simple. You're $100 billion fund and you have to invest 10% of your money, or you want to invest 10% of your money. You don't have to. Are you going to invest 10% of the money when VIX is at 20 plus? Or are you going to try and hedge it out, reduce size, rather than or instead of it being at 9, right? At 9, you'd rather take the full size, volatility is small. Um, the daily fluctuations aren't going to be that huge. At VIX 20 plus, 30 plus, you're reluctant to allocate that much size because the fluctuations of the underlying are almost uncontrollable without a hedge. Like we're talking, you've probably seen ES whipping around every day. It's not like it was 2 years ago in 2018. Let's go to SPY. I mean,
Yeah,
we
like
could take
this isn't really the environment that people want to put a lot of money into.
right. Like let's go to like 2018. I mean, even on these ramps, we're talking 72 basis points, 64 basis points. I'm taking random. There's probably a better study we could do, but I'm looking at like 3 basis points, 12 basis points, 60 basis points, right? 30 basis points. Even here in these volatile moments, we got 54 basis points, 197 basis points, 150 basis points. They get dried up rather quickly, right? Then we go back to like we go back to under 1 basis point moves rather quickly. And there's a drop again, but we kind of chop sideways here, under 1 basis point to 1 to 1.25 in areas. We go to where we are today, right? Like we're talking like we're whipping all over the place. We're going within 30 days. We have the market literally rallied vertical. If I do the math here from the low, let's do the second. Let's do the other. I'll give it some time. Within 15 days, the market rallied 11, roughly 11%.
Yeah. Just imagine
11%.
like funds managing billions. Like imagine if they went short,
Right.
11% loss right there in 15 days.
Right.
That's detrimental for hedge
Yeah.
funds.
Yeah. And I mean, the problem is hedge funds also use derivatives too. Um, it, they're in futures options and stuff like that. So it's not just all straight equity, long or short. They actually take on some leverage. And quite frankly, if you look at the statistics, historically, hedge funds actually haven't really hedged shit. You know, like there's like some really good funds out there that are very notable and like the managers are very successful for a reason. But like a lot of funds are just like they're leveraged long Nasdaq. Believe it or not, if you look at their underlyings, they're long tech, and they're getting paid because they're along the right tech. But they all have the same underlying risk in the case of a oh shit scenario because again, they're all long the same thing and they have to all deleverage at the same time. And if we look at the stress index, you could see that's what you saw going into January. Everyone had to deleverage at the same time, and it literally moved the stress index almost 30 points higher.
Hmm.
Well, actually, did it? Yeah, did. Over 30 points higher.
Yeah.
So, I mean, we got another 28 points to go and we're at 0. We'll see if we get there. But a way we could make a way I guess we could revert this into making money with the stress index is to understand, when does the stress happen? The stress happens in risk off environments. That's when you see the most explosion of stress. And we know when risk off environments happen, usually a few weeks to a month before they do, based off our regime model. So our regime model tells us that financial stress is coming.
Yeah. And
There's no
that essentially means volatility is coming.
right, and you have to basically or I should say deleverage the portfolio because things are about to change.
Yeah.
There's also one other component that you can look at, and I think that's where we're going to leave it off with, and that is the old dollar index, the DXY, right? So this is actually a simple one. The dollar index has been on a tear since June, July of 2021. And what this is showing you, or what the dollar index is, first off, the dollar index is not like what other currency prices are. Like, for example, the euro or the yen. The dollar is priced in a basket of currencies. I think we went over this in the last one, or the podcast before that already. We were
Probably. But
talking about, like,
that's a whole other topic of discussion, the way currencies are priced.
right, yeah, yeah. But long story short, the dollar is a basket of currencies, but the dollar is showing you demand for the US dollar. So if the dollar index is grinding higher the way it is, it's showing you that there's a sign of demand for cash. And it also means that there's less support for market function operations. Like, we can go back to the bid and ask spreads, the book depth. There's obviously going to be less and less book depth if there's more and more dollars in demand, because more people are holding cash or cash equivalents, or
Yeah. So
looking
they're
for dollars.
essentially they're taking money out of the markets.
That's a great way to put it, right? So you can look at this and you could say, like, look at COVID, right? COVID, we had the first drop, and then we had this ultra rally, which was people pulling money out of the market,
Oh, interesting.
right? And let's go back to the. I mean, let's see if we can overlay this for our video viewers here. Let's see if we can overlay this with the ANFCI. There you go. So you can see what I mean by the rising dollar is is a sign of stress on the market.
Oh, it actually seems to lead the ANFCI.
Yeah, it probably does, because remember, the ANFCI is stress on money markets and debt markets and so on and so forth in the banking system. If there's more cash on hand, there's less money being lent. So it's likely that that's an increase of stress, as less money is out there for swaps or whatnot, right? Um, and I mean, you're also seeing, like, consumer credit, right? A lot of these consumer confidence is fading too now, right? Like, there's a lot of things that are fading, and you can line them up with stress, because when people are not confident, they tend to hold back, because they're uncertain of their future. In turn, they're going to hoard cash, or they're going to do conservative things. But um our monetary system is built off of lending, right? To buy a house, you take a loan. Like, these are all, like, things that you have to do in society. So if the lending slows down, it's quite obvious that there's going to be more stress on the economy, because our economy is a debt-based economy,
Yeah. And that
right?
ties into interest rates rising as well.
There you go. There's a lot of things that play into this factor of stress. But I think to wrap this whole conversation up on liquidity is, when you look at liquidity, think of liquidity as stress on the market and the economy. More stress on the market and the economy is going to mean less liquidity. If there's more stress on the economy, what do you think people are going to do? They're going to take cash, which is what you're seeing, right?
Yeah.
And if there's more stress on the economy, You're going to see consumer confidence falling, which you're seeing that too. We had the lowest reading in like I think it's a decade, right?
Yeah.
Those are the things that are a sign of liquidity draining. And then you pull up something like the ANFCI, and that's a real simple one. That's a real simple indicator. Those that have trading view, type in ANFCI, and you'll see right away anything above zero is you're starting to get into a strong tightening area of the economy. Where anything under zero, you still lose. So while we did rise in the last 2 or 3 months, we're still rather loose, believe it or not. We haven't taken out the 2016 peak. So it's not the end of the world, but that would make sense because it's stagflation,
Yeah. And
right?
if we get a deflationary pivot, it's definitely going to go higher for sure.
Yeah, yeah. And because that would mean that, again, remember what's in demand in deflation: bonds, gold, all these things that are, um, first off, the dollar's a great performer. And believe it or not, the dollar's a great performer in a deflationary environment. And the fact that that it's doing so well now is quite interesting because the dollar really isn't supposed to do this well in stagflation. And there's some people out there that say like, "Oh, we're in deflation," right? There's a lot of different callings for what we talk about, different ways to look at it. But primarily, if you look at commodities, commodities may have peaked. We don't know yet. I mean, we take a look at DBC real quick, right? Commodities may have put a peak in. We'll see, but we're not going to bet the house that commodities have peaked yet. That doesn't make any. We don't have to. There's no reason for us to make that bet. But back to the dollar. Um, the dollar is doing what it should be doing in deflation, but this is the only thing that's doing what it should be doing. I mean, you look at TLT bonds
Yeah.
getting smoked, so it's obviously not a very strong deflationary regime if you want to call it deflation. It's acting very much like stagflation, which is what we've been saying, and we've been on top of this regimes,
Well, it
for
kind
the
of goes
last.
along with we're in stagflation, but we are kind of like in the teetering area between
Right. That's a good.
stagflation and
Yeah.
deflation,
Yeah.
right? So like you're going to get some things like the dollar being deflationary, but you're going to get other signs of stagflation. So you're getting like a bit of a mix of both. It's kind of like a bad stagflation.
Right, and that goes back to us this being a stagflation that we have not seen in like 40 years.
Yeah. So
Yeah,
that's
but
just the way it is. But let's wrap it up. Let's talk about our positioning right now, how we're positioned for stagflation, what what you should be doing. So we're expecting real yields to go positive as they have been. We've been saying real yields are going to be going positive since like I think February. Pull up what they're at. Let's see what they're at. So we got US 10-year minus 10-year break evens. We're
and
getting close to zero.
yeah, but let me see if I can pull up the here. Pull this up. Let's see what the real quotes are because the one downside of the US 10-year minus 10-year YI minus excuse me, the minus T10 YIE on TradingView is that one of these values is reported daily while the 10-year is live. So this may not be this high. If we go to Bloomberg.com markets slash, excuse me, Bloomberg.com/markets/rates bonds, you could go under US and you could see the tips. Yeah, no, see, we're at negative 13 basis points right now.
Okay.
This is the most accurate. But yeah, I mean,
But
regardless, I mean,
yeah,
we're getting
we're
close.
zooming up there, which this is exactly what happened last time we were negative yields
Yep, we
back in
go
like I don't
vertical.
even know like 2014
Let me
20
see
yeah
here.
2013. It literally went vertical, and
Yeah, right here.
that's kind of what we're seeing right now. And once we get up there into the positive territory, that opens up the door for deflation because then you get cash coming out of equities and pouring into bonds, and
Right, right. And let's
that's when
compare
you'd really see
this.
a big market sell off. That's why we haven't seen a market sell off, a real market
See?
sell off yet. It's been very stagflationary, choppy, sideways.
Yeah, and as you can see, for those that are watching on video, uh, real yields are very much correlated to bonds. So real yield bond TLT peaked when basically real yields put a bottom in, and TLT was a buy when real yields peaked in November of 2018. That's when it went vertical, and real yields peaked. TLT bottomed. That's how this works. Another thing that we'll pay attention to is gold, right? I mean, if we put up gold on the chart, you'll see it's very much correlated to bonds and real yields. Again, gold peaked when real yields bottomed. Hence, on the recent gold rally in early March, we weren't able to take out the prior highs or sustain a move above there because real yields were way, way, way above their bottom. And what you noticed, what actually happened was we'll disable TLT. Real yields took a dive initially, which gold got that gold pump everyone was talking about was the dive in real yields that quickly recovered.
Yeah, and that was actually the bottom that we picked up
Oh, yeah, on
on
the
the
tip
public
puts.
account.
Yeah,
Yeah, that was a
we
good dip buy there.
yeah, we got the tip puts here, and we'll run through that because that's actually a good one to have go through. So we own these tip puts, and we don't have a set price. Our option price is like way down here, 115. What we do have in our favor is back-to-back Fed hikes, so they're going to affect real yields. That's number one. Number two, we're looking to take some sort of profit at when real yields or get to zero. We're at negative 13, as we said right now. As this gets closer to zero, we're going to start taking profits. But just take a look here at the tip section and the entire duration set of tips. The 30 and the 20 and the 30-year tips are both trading well positive at 23 and 25 basis points right now. And 10 years approaching zero. Is it going to take the 5-year to get to zero to really to really start this deflation pivot? I don't know. That's something I'm still trying to figure out, but that would be something
Yeah.
because that still has another 63 basis points to go. So that
That's
in
gonna
turn,
mean it's gonna mean long stagflation if
right,
that's
but
the
it also
case.
yeah, but it also means that the 10-year would not only go to zero but could go much higher. Remember, that's the one thing that we were watching, right? Like, hold on. The 10-year at zero doesn't mean just because the 10-year or the 10-year tips hit zero doesn't mean that the deflation trade is on. Like the 10-year tips could go well positive,
Yeah.
20,
And that's
40.
probably what's gonna happen.
Right.
That's really the
I,
kind of
I, I
environment you need for a deflationary regime.
yeah, I have a feeling that's going to happen as well, but we'll see.
But
Um,
it could happen quick. That's the thing.
yep.
That's the thing. Like it really can spike up there. And so bottom line, that's our thesis. Still risk off. Stagflation is really that regime where we don't have a strong play. Like in deflation, we've got a strong play. We've got long TMF play, which we would allocate more than 50% of our portfolio into that because it's basically a guaranteed play. Easy money, money printer. That's what we do. Stagflation, unfortunately, that's just the kind of regime where cash is king. And
Yeah.
so we just got to sit tight, sit back and relax and wait for a high probability trade to come on the table. Right now, our highest probability trade is our tips trade with real yields going to positive territory.
And if you know anything about Artie and me, which you guys probably don't, but here's a little tidbit about both of us. The time we brought market radar to the surface and made it public would be the time we got stagflation. Let's just put it that way.
Yeah,
This
that's
would
just our
be
luck.
yeah, that's just our luck. The time we come out to you guys and show you guys the keys to the kingdom is when we get stagflation. But that's life, right? That's the markets. We got to keep adapting. We got to keep pushing forward, and we can't. The one thing we don't ever do at market radar or in our lives in general is we never settle. Right?
Yeah,
There's never enough you can do to achieve excellence because excellence is never achievable. We just got to keep pushing forward. And that's what we do every day. Try and be better. And hopefully you guys can get something out of this. Again, it's all free. So I hope you guys are getting at least something out of this, you know? And yeah, I think we'll leave it off with that, right? You want to cut
yeah,
it off here?
Yeah. Thanks for listening. We've got a
Yep.
Discord if you have any questions, and we'll talk to you next time.
Yep. We'll be back next week for the next episode.